All right, welcome to the Explainer. Today, we've got a real financial showdown for you, a classic tale of two titans in India's lending space. We're going to look at their latest earnings and figure out whose strategy is really paying off. You've got the massive, do-it-all giant on one side and the super focused, nimble challenger on the other. This is going to be good. So let's set the stage here. On one side, you've got Bajaj Finance. We're calling them the all-rounder. And really, think of them like a giant financial supermarket. They've got a product for pretty much anything you can imagine. And on the other side, we have Fedbank Financial Services, or Fedfina for short. They're the specialist. Their game is totally different. They're all about mastering one specific thing, lending that's secured by real, solid assets.
Okay, so what we're going to do is break down their latest quarterly performance. But this isn't just about who made more cash. No, we're digging deeper. We want to understand their completely unique game plans for growth, how they turn a profit, and how they handle risk in this incredible, booming market. So yeah, let's dive right in. All right, first up, let's talk growth. This is where you can really see how different these two companies are. It boils down to a classic question, right? Is it better to be bigger, or is it better to be faster? So, first, let's just take a moment to appreciate the sheer scale we're talking about with Bajaj Finance. Their assets under management, or AUM, is a staggering 4.6 trillion rupees. I mean, that's a number that's kind of hard to even wrap your head around, right? It gives them this absolutely massive footprint across the entire Indian economy. And then you see this. Talk about a stark contrast. Fedfina is a really strong player, don't get me wrong, but they're playing a totally different game. Their AUM is just over 16,000 crore rupees. And you have to understand, this isn't a weakness. Not at all. It's actually the entire point. It's the very core of their focused strategy. And this is what that massive scale lets Bajaj do. Get this, in a single quarter, just 3 months, they added over 4 million new customers. To put that into perspective for you, that's like adding the entire population of New Zealand to their books in just 1 quarter. It's an absolutely incredible customer acquisition machine. But here's the thing. While Bajaj has that mind-boggling scale, Fedfina has incredible speed, but only in its chosen arenas. See, they're not trying to be everything to everyone. Instead, they are just crushing it with massive year-over-year growth in their core businesses. We're talking loans against gold and property. Their total loan disbursements, they jumped over 36%. That's some serious momentum. Okay, so you've got scale on one side, speed on the other. But how does that actually translate into their business models? How are they actually structured to make money day to day? Well, when you look at Fedfina's loan book, their strategy is just crystal clear. More than 96%, think about that, of their entire portfolio comes from just 2 things: mortgage loans and gold loans. This is the specialist playbook in action. It's all about deep, focused expertise in secured lending. And this focus on collateralized lending, where every single loan is backed by a real physical asset like a house or gold, that's the bedrock of their whole business. It's how they deliver on their vision, which is empowering emerging India with easy access to loans. They do it by providing credit that's fundamentally trustworthy because it's backed by something solid. And wow, this is just the perfect contrast with Bajaj Finance. Their portfolio isn't focused at all. It's like the sprawling, diversified map of the entire Indian economy. You've got urban consumers, mortgages, small businesses, the rural market. I mean, they are truly, truly everywhere. This is that financial supermarket model we were talking about, in action. I mean, they'll give you a small loan for a new phone, and in the next breath, they're providing massive financing for big corporations. And the key to it all, they leverage their gigantic customer base. We're talking over 110 million people to cross-sell this whole universe of products, everything from loans to insurance to payment cards. So what's powering this whole all-rounder strategy? Well, it's a massive investment in technology that they call Phi AI. And what they're doing is embedding artificial intelligence into basically every single part of their business, from customer service bots to how they approve loans. The goal here is to become this hyper-efficient, totally future-ready leader in the space. Okay, so we've seen the strategies, we've seen the scale versus the speed, but how does all this translate to the bottom line? Let's check out their profits and maybe, even more importantly, how they're managing risk. Now, before I show you the numbers, we got to quickly understand one key metric for any lender. It's called net non-performing assets, or NNPA. All it means really is what percentage of their loans have gone bad, the ones that are at risk of not being paid back.
And for this number, just remember, lower is always better.
Okay, now this is where it gets really interesting. At first glance, you see that both companies are growing their profits at a very similar, very healthy clip, right around 24%. But if you look closer, you start to see the different strategies playing out. Bajaj's tech and massive scale, they likely contribute to that much lower percentage of bad loans, and that in turn leads to a significantly higher return for their shareholders.
So, what's the big takeaway here? It's not really about picking a winner and a loser. What we're seeing are two very distinct and, frankly, so far, very successful blueprints for what the future of finance in India could look like. You've got the all-rounder, Bajaj on one side. They're betting big that scale, data, and technology can create this unbeatable one-stop digital shop for everything financial. Then you've got the specialist, Fedfina. Their bet is that security, trust, and deep, deep expertise in collateral-backed loans will always be valuable to a specific kind of customer. And that really leaves us with one final fascinating question to chew on. As India's economy keeps growing and as people's financial needs get more and more complex, which of these two powerful models do you think is better poised to win in the long run? Will it be the all-encompassing digital supermarket, or will it be the deeply trusted specialist? Something to think about.